Welcome back to Talk Tickers. This is the show for the professional investor class, and we are the place where we don't just, read the headlines.
No.
We strip mine earnings calls for alpha. We take the noise, the guidance, that specific tone of voice from the C-suite, and we distill it all down to what actually matters for your portfolio.
It's really about finding that signal in all the noise.
Yeah.
And today, we have a tremendous amount of noise to cut through.
We certainly do. Today's ticker is mRNA, Moderna. And the context here is, well, it's absolutely fascinating. We're digging into the Q4 2025 and full year numbers, which just dropped on the morning of February 13th, 2026.
And let's be honest, the narrative around Moderna for the last, 18 months? It's been a
post-pandemic hangover.
That's putting it politely. I'd call it a full-blown identity crisis. Mm-hmm. Is this a COVID company that's just slowly fading into obscurity? Or is this the dawn of a real respiratory platform?
That's the question.
That's the existential question the street has been asking over and over.
Exactly. And this earnings print, it wasn't just numbers on a page. This was a battle for that very narrative.
Right.
The street was honestly expecting a bloodbath on the bottom line. Sentiment was just incredibly low. But management, they came out swinging.
They really did.
They didn't just trim costs. They took a machete to the cost structure.
And the market noticed. Instantly.
They sure did. The market voted with its wallet. The stock popped, about 4% pre-market?
Yeah, and it held. Closed up over 5% at $42.23.
On heavy volume, too. We're talking 2.1 times the average daily volume. This feels like a relief rally.
It is. It's a rally fueled by pure discipline, not by growth, by discipline.
So our mission today is to unpack this beat, to really look at this massive cost restructuring, and then we have to figure out what on earth is going on with the FDA regarding their flu vaccine.
That's a whole can of worms.
It is. And then we'll analyze this conservative 2026 guidance that seems to have investors finally buying the dip.
It's just a fascinating setup. You have a company that's shrinking its top line, pretty significantly year over year, and yet the stock is rallying.
Right.
And that tells you everything you need to know about what investors actually care about right now.
Which is?
Capital preservation and the runway to the pipeline. That's it.
Okay, let's get right into it then. The numbers. We call this the results snapshot. What were the headline figures that got everyone so well relieved?
So let's start with the top line. Revenue for Q4 came in at $678 million.
Okay, and where was the street on that?
Well, the consensus, it was somewhere in the range of, call it $652 to $662 million. So, it's a solid beat.
A beat of about $15 to $25 million.
Exactly.
Hold on, though. $25 million on a, $600+ million base? Is that really a huge deal? It's not a blowout.
No, it's not a blowout in that, traditional growth stock sense. But
yeah,
you have to think about the environment here.
The fear.
The fear was that revenue would just fall off a cliff because of low booster uptake. Right. So in that context, any beat is a good beat. It signals that the floor is holding up.
Okay, fair enough. So the top line wasn't the main event.
Not at all. The main event was the EPS, the earnings per share.
This is where the real surprise was buried. Moderna posted a loss of negative $2.11 per share.
And hearing loss never sounds great, but it's all about expectations.
You have to look at what was priced in, and the consensus was ugly. Truly ugly. The street was expecting a loss somewhere between negative $2.55 and negative $2.62 per share.
So they beat the bottom line by nearly 50 cents.
50 cents.
That is a massive beat.
It really is. When you're losing money, losing 50 cents less per share than everyone thought you would it's effectively a massive profit surprise.
It shows that the operational cuts, they're not just talk. They are really starting to show up in the math.
Right. And just to put the full year 2025 in context, what were those numbers?
Total revenue for the year landed at $1.9 billion. And that came with a net loss of $2.8 billion for the full year. But the number that really just made my eyes pop out of my head was on the balance sheet. Let's talk about the cash position.
This is the fortress. This is what safeguards the whole thesis. They ended 2025 with $8.1 billion in cash and investments.
$8.1 billion. Now, hang on a second. I remember looking at their guidance from earlier in the year. They were not supposed to have that much money left.
You are exactly right. The delta here is just shocking. If you go back to their Q3 guidance, or even earlier in 2025, they were guiding to end the year with roughly $6 billion.
Maybe a little more, yeah.
Maybe. They ended with $2 billion more cash than their own forecast implied.
How do you just find $2 billion? Did they, check the couch cushions in the boardroom? Is this some kind of accounting gymnastic?
It's a totally valid question. And no, it's not magic, but it is incredibly aggressive management. It's a combination of things, but it really boils down to two key areas: extreme cost discipline and working capital management.
We have to dig into that.
We will. But the headline is, Q4 operating expenses were down 31% year over year.
31%.
That is a staggering reduction in spend for a biotech company that's supposed to have this huge, expensive late-stage pipeline.
That is serious austerity. That's usually the kind of cut you see in a pre-bankruptcy restructuring, not a growth pivot.
And the market reaction just reflects that sense of relief. As we said, it closed at $42.23, up 5.29%, and the sentiment seems to be shifting.
To cautiously bullish.
Yes.
It's a reward for the pivot. I mean, the market was punishing them for this growth at all costs mentality back when the COVID revenues were just vanishing.
Right.
Now that they've pivoted to cash preservation and strategic bets, the market's willing to give them a higher multiple, or, at least a floor on the valuation.
And the options flow back that up. We saw that implied volatility crush post-earnings.
Which is classic relief.
It says the floor didn't fall out. It wasn't some euphoric call-buying spree, but it was a collective sigh of relief from the market.
Exactly. The absolute disaster scenario was officially taken off the table.
Okay, let's unpack this. We need to move into our first deep dive segment, the financial turning point. We have to understand how they did this because the CFO, Jamie Mock, he explicitly framed 2025 as a turning point.
And he was right to do so. The story isn't just about selling vaccines anymore. It's about stopping the cash bleed. And if you look at the breakdown of the savings, it's comprehensive. Cost of sales, or COGS, decreased by 41%.
41% decrease in COGS. That's huge. How do you even drive COGS down that much? Is this sustainable, or is it just some one-time accounting trick?
It's a mix, but I'd argue it's mostly sustainable. First, you've got simple productivity improvements. They're just getting better at making this stuff. The yields are up, less waste.
Okay.
Second, and this is a big one, fewer inventory write-downs. Remember in 2023 and 2024?
Yeah, they were writing off billions in expired COVID shots.
Billions. That drag on the P&L is largely gone now. And third, they're winding down old contracts with manufacturing organizations, the CMOs.
So bringing more in-house?
Bringing it in-house or just moving to more efficient partners, cutting out those expensive middleman fees.
Okay, so making the product itself is getting cheaper. What about the labs? R&D was down 31%. Now, usually when I hear a biotech is cutting R&D by a third, I get really nervous.
As you should.
Are they eating their seed corn here? Is this a sign of trouble?
That is the valid concern, and I think investors should be asking that question. But management's argument is that this is portfolio prioritization.
So not cutting across the board.
No, they're not cutting the late-stage stuff that's on the verge of making money. They're cutting the exploratory, early-stage, nice-to-have projects. They are focusing fire on the things that can launch in 2026, 2027, and 2028. It feels more like discipline than, say, desperation.
And SG&A, the selling, general, and administrative expenses.
That was down 13%, which is, efficiency across functions. More targeted marketing spend, back office automation, the usual corporate belt tightening. But the unsung hero of this call, the thing that really drove that massive $2 billion catch beat, was working capital efficiency.
Explain that. Working capital is not the sexiest topic, I know, but $2 billion in extra cash is very, very sexy.
It's the mechanics of cash flow. It's the boring stuff that makes or breaks a company. Get this. Receivables were only at $180 million.
So they're collecting cash quickly.
Very quickly. And inventory was flat at $270 million. Do you know how hard it is to keep inventory flat when you're in the middle of launching new products like their RSV vaccine?
It implies a just-in-time supply chain that is actually functioning perfectly.
Precisely. They squeezed $1.2 billion, $1.2 billion of unexpected cash savings just out of operations.
Just from managing the balance sheet better.
Yes. Collecting money faster from customers, paying their vendors on optimized terms, and not building up these excess mountains of inventory that might expire. That $1.2 billion is effectively free financing. They didn't have to raise debt or dilute shareholders to get it. They just managed the business better.
That is genuinely impressive, and it buys them time.
A lot of time.
Speaking of time, let's look at the 2026 cost framework they laid out on the call.
Okay, this is where the runway really gets extended. They guided total GAAP operating expenses to approximately $4.9 billion for 2026.
Okay, $4.9 billion gap.
But more importantly, the cash costs are expected to drop to roughly $4.2 billion.
And R&D spending. You said they're not gutting it, so it's staying roughly flat or maybe down slightly to about $3.2 billion.
Correct. They are absolutely keeping the R&D engine running, but only for that late-stage pipeline, the cancer vaccines, norovirus, the rare disease programs, and they're funding it by cutting fat everywhere else.
So the analysis here is pretty clear then. This level of austerity extends their runway out significantly.
It puts a floor under the stock. Think about it. With $8.1 billion in the bank and a net cash burn rate that is slowing to maybe, let's call it, $2 billion a year.
They have 4 years.
They have 4 years of runway without selling a single new product. That removes the imminent threat of a secondary offering or some dilutive capital raise. They don't need to raise capital if they hit these targets.
That is a massive, massive comfort for investors who've been burned. Okay, let's pivot from saving money to making money. The top line, segment 2, the 2026 commercial outlook. And this really feels like a show-me story.
It absolutely is. They're projecting, and the language is key here, up to 10% revenue growth for 2026.
Up to 10%. That's it. Well, it's modest, but this is where it gets really interesting. What is baked into that number? Or maybe more importantly, what isn't baked into it?
This is the safety in the numbers that I was talking about. This guidance assumes zero. I mean, absolutely zero. Revenue from the U.S. flu vaccine or the combo flu plus COVID vaccine.
Zero.
So
if they get approved, if they manage to sell a single dose of flu vaccine in the United States next season, that is pure upside to the model?
Exactly. It sets a very, very beatable bar. If the FDA issues get resolved, and we'll get to those headaches in a minute, it's bonus money, pure gravy. If not, the guidance stands on its own based on the existing COVID business and their international sales.
Speaking of international, there's a huge geographic pivot happening here, isn't there? In 2025, the split was what, 62% U.S., 38% international?
Yeah, heavily skewed to the U.S. But for 2026, they expect a balanced 50-50 split.
So U.S. reliance is dropping. What's driving that?
It's these long-term partnerships that are finally coming online in the U.K. and Australia.
Right, they built facilities there.
They did. So they have these government contracts that are effectively take or pay, or at least highly committed. And on top of that, they've got new deals in Mexico, Taiwan, and Brazil.
So this is shifting the company from being a U.S. retail pharmacy play, which is very seasonal and unpredictable,
Right.
to a global sovereign contract play. And that feels a whole lot more stable.
It is more stable, but it introduces a new risk, or I guess a quirk that investors really, really need to understand. And we're calling it the air pocket.
The air pocket. Okay, this is the seasonality warning.
Yes. They were very clear about this on the call. The guidance is heavily backweighted. They expect only 15% of their total annual revenue to come in the first half of 2026.
Whoa.
And the other 85% will come in the second half.
15% in the first 6 months? That is drastic.
It's drastic. And it's dangerous if you aren't paying close attention.
So the Q1 and Q2 earnings reports are going to look, they're going to look terrible on the surface.
They'll look light, and the headlines can be really scary. If you're an investor who just looks at the quarterly print without understanding the seasonality, you might panic in April or July.
Right.
But the revenue isn't gone. It's just locked into these government contracts that deliver in the fall and winter, for the respiratory season.
That requires patience. And in this market, patience is, it's in very short supply.
It creates a really dangerous setup for the stock in the first half of the year, but a potentially explosive setup for the second half if they deliver.
Okay, let's talk about why that revenue is so backweighted and, more importantly, why that U.S. flu number is guided to 0. Segment 3. The regulatory roller coaster. The bad news from the call was that the FDA issued a refusal to file letter for their standalone flu vaccine, mRNA 1010.
A refusal to file, or an RTF, it's a real slap in the face. It's not a rejection of the data's quality, not necessarily. It's a rejection of the application itself. The FDA is basically saying this isn't complete, or this doesn't meet our formatting or content standards, so we're not even going to look at it.
And Stefan Bancel, the CEO, on the call he sounded pretty frustrated.
He was visibly frustrated. He started citing unpredictable review timelines and regulatory uncertainty in the U.S. He basically went on a bit of a rant saying this kind of environment is damaging the entire innovation ecosystem.
And when a CEO starts blaming the ecosystem, things are really bogged down.
Oh, yeah.
So let's get technical for a second. What is the core issue here? Is the vaccine bad? Did the data miss?
No, and that's the frustrating part. The data actually looks quite strong. They show 27% superior efficacy versus the standard dose flu vaccines that are out
Yeah,
there.
that's a great number.
It's a fantastic number. The issue is likely technical and bureaucratic. It's probably related to their active comparator data.
Okay, unpack that for us. What does active comparator mean in this context?
So when you run a trial for a new drug, you have to compare it to something. For flu, you compare it to an existing approved flu shot. That's the active comparator.
Got it.
And the FDA seems to be changing its views on things like strain selection and what constitutes a valid control arm in these non-inferiority studies.
So the goalposts moved.
Essentially, yes.
Right.
The goalposts might have moved regarding which flu strain was prevalent in the population during the trial versus which specific strain was in the comparator vaccine they used. It's a technical, bureaucratic quagmire.
And the irony here is, while the U.S. is stalling, what's happening in the rest of the world with the same application?
The divergence is just stark. The exact same file has been accepted and is under review in Europe, in Canada, and in Australia.
Wow.
Those regulators looked at the same data package and said, okay, this looks complete, let's review it. The FDA said, don't even bother filing it.
That really supports Bansel's frustration then. But this has a knock-on effect for the big prize, the combo vaccine, right? The 1083.
A massive implication. The combo is flu plus COVID. You can't file the combo until the flu component is cleared. So the combo filing in the U.S. is completely paused until this standalone flu path is clarified. They've requested what's called a Type A meeting with the FDA to try and hash this out.
So the U.S. regulatory path is a complete mess for now, but management is still arguing the data is strong. That 27% superior efficacy number is real.
And that's the source of the frustration. They believe they have a better mousetrap, but they can't even get it through the front door in their own home market.
Which is why that international pivot is so critical now.
It's everything. They can launch in Europe and Canada while they continue to fight with the FDA.
Okay, so let's look beyond the flea mess. Let's look at the shiny objects. Segment 4, the pipeline. Specifically, oncology. This is the dream, right? This is what everyone is really buying the stock for.
This is the call option on the stock. Absolutely. The INT, individualized neoantigen therapy that they're developing with Merck, this is the crown jewel of the entire pipeline.
And we just got some new data, the 5-year phase 2B data in adjuvant melanoma.
We did, and it was really impressive. It showed a roughly 50% reduction in relapse or death. But the key thing, the most important part of that data, is that the curves remain stable. They're not converging.
Explain why that's so important.
Well, sometimes in cancer trials, you see a benefit at year 1 or year 2, but then by year 5, the curves start to merge.
Meaning the benefit fades away.
Exactly. Everyone eventually relapses. Here, the benefit seems durable. The separation is holding. That suggests this could be a real long-term fix for some patients.
And what about enrollment wins in other cancers?
They announced that the muscle-invasive bladder cancer phase 2 trial is now fully enrolled. That joins renal cell carcinoma, which is also fully enrolled. So they now have multiple shots on goal in cancer. It's not just a one-trick pony.
And the big catalyst we're all waiting for.
The phase 3 adjuvant melanoma interim analysis. It's expected sometime in 2026. This is the big one. It's the binary event for the stock.
So if that phase 3 data replicates what we saw in phase 2...
The stock is, well, it's a different company. The narrative changes overnight.
It changes the entire valuation model.
Completely. It moves from being valued as a declining vaccine company to being valued as a potential cancer cure company. Yeah. That's a whole different multiple.
Okay, what about the sleeper hit in the pipeline? Norovirus.
I love this one. The phase 3 is fully enrolled, and the market seems to be completely ignoring it.
Why is this one different from, say, the flu vaccine?
Because of the trial design. Flu is messy, like we said, because you have to compare it to existing vaccines. Norovirus, there is no vaccine.
So it's a placebo-controlled trial.
Exactly. It is a much, much cleaner regulatory path. If you beat the placebo by a statistically significant margin, you win. It's that simple.
And the target population for noro?
Older adults, 60 plus. A very high unmet need. I mean, a norovirus outbreak in a nursing home is an absolute disaster. Yeah. There's a massive market for this, and Moderna is leading the pack.
And just to round out the pipeline, what about rare disease, PA and MMA?
They're moving toward registrational data. Now, these are smaller markets for sure, but they're very high value per patient. And more importantly, it helps prove the platform works for replacing missing enzymes, not just for creating immunity. It broadens the whole story.
Okay, we've covered the numbers, the strategy, the regulatory mess, and the pipeline. Let's zoom out for a minute. Investor context. How do we even value a company like this right now?
It's a total valuation reset. You're right. The stock is not trading on 2026 earnings multiples because, frankly, there are no earnings. There are losses.
So what is it trading on?
It's trading on cash plus technology value. That's it.
With that $8 billion in cash we talked about and a burn rate that's slowing to around $2 billion a year, the enterprise value, so the value of the actual business and technology, is factoring in very, very little success for that oncology pipeline.
And that's the whole upside case. If INT works in phase 3, the current stock price is arguably a steal.
Right.
You're essentially buying the respiratory business to pay the electric bill, and you get the cancer lottery ticket for almost free.
And the downside case, to be fair.
The downside is if that respiratory revenue degrades even faster than costs, if COVID goes to zero and flu never gets approved in the US, then the cash pile burns away before the cancer drugs can hit the market. It becomes a race against time.
What about the broader sector and macro environment? How does Moderna fit in?
Well, biotech in general.
Yeah.
The XBI, the IBB, has been performing well, up 25 to 35% year over year. Moderna has lagged that group a bit.
Right.
But this beat and discipline strategy is exactly what investors in a high-rate environment want to see. They don't want growth at any cost anymore. That's a 2021 story. They want capital efficiency. And Moderna is finally speaking their language.
And the strategic narrative, to sum it up,
they are successfully rewriting their story. It's a slow process, but it's happening. It's no longer just the COVID company. It's becoming the mRNA platform company.
And the evidence for that is the 2026 growth.
Exactly. It's driven by those diversified international contracts,
right?
Not just by U.S. retail boosters. That's the proof.
It's a fascinating transition. It's almost like you own this respiratory cash flow business to keep the lights on.
But you hold the stock for that cancer breakthrough.
It's a classic biotech barbell strategy.
But with a massive $8 billion cash cushion, which is not something you usually see.
All right. That brings us to the part of the show that everyone waits for, the part where we take off our responsible analyst hats.
And put on our degenerate trader hats. My favorite time of the week.
Okay, disclaimer time. This is not financial advice. We are just two voices in your headphones. Do your own diligence. Please do not sue us if you lose a bunch of money on this.
Seriously, don't. These are just ideas to get you thinking. Plausible, but outrageous ideas.
Okay, here is the setup. We have a stock with a massive air pocket coming in the first half of the year. Remember, only 15% of their guided revenue is coming in H1.
Which means the news flow will likely be quiet or, potentially negative on the surface.
And then we have a massive wall of catalysts in H2. You've got 85% of the revenue hitting, plus that potential phase 3 cancer data. And importantly, implied volatility is crushed post-earnings.
So options are relatively cheap right now.
Exactly. So here is the hedge fund analyst pitch. I'm calling it the hibernation calendar spread.
Ooh, I like the name. Break it down for me.
The thesis is simple. The stock is going to go nowhere, or maybe even drift a little lower in Q1 and Q2 because the revenue numbers will look light and there won't be much news. The real fireworks happen in Q3 and Q4.
Makes sense. So what's the trade?
The trade is, you go short, you sell the June $45 calls.
Okay.
You are collecting that premium, and you're making a bet that the upside is capped during this quiet period. You're betting it stays below $45 until the summer.
Okay, so you're selling the short-term help.
Exactly. And you use that cash you collected to go long to buy the January 2027 $50 calls.
Ah, so you're exposed to the back-end loaded revenue and, more importantly, that oncology data readout in late 2026.
Precisely. You finance the long-term high-impact bet with the short-term boredom. If the stock just chops around between $40 and $45 for the next 6 months, you get to keep the premium from those short calls you sold.
And if it rips higher in December on good cancer data?
Your long calls print. Big time.
That is a very clever way to play the seasonality of the business. You're essentially monetizing that air pocket we talked about.
Okay, what's your idea? Give me an alternative.
All right, my alternative idea is the norostraddle.
The norostraddle. I'm intrigued.
So my thesis is everyone is focused on flu and COVID. That's all the headlines are about. The market is completely sleeping on the norovirus data, which is coming sometime in 2026.
Right, the sleeper hit.
If noro hits, it opens up a brand new multi-billion-dollar monopoly market. No one else has a vaccine for this.
True. So what's the trade? A straddle implies you're betting on a big move, up or down.
Not exactly a textbook straddle. It's more of a speculative call play. Look for cheap, out-of-the-money calls expiring in late 2026 or early 2027. You're playing for the surprise pipeline win that absolutely nobody has priced into the stock right now. If that noro data is good, the stock is going to move, regardless of what the FDA says about flu that month.
That's a pure pipeline play. High risk, high reward. I like it.
Exactly. It's a binary bet on a non-consensus catalyst.
All right, great stuff. Let's wrap this all up. A final recap.
Moderna delivered what I would call a quality beat. Revenue was up versus expectations, but more importantly, costs were way down. And that cash pile is surprisingly high at $8.1 billion.
And 2026 is a transition year. They've guided to up to 10% growth, but you have to remember it is heavily, heavily back-weighted to the second half of the year.
The regulatory fights in the U.S. are going to continue, particularly on flu, but they have those green lights internationally in Europe, Canada, and Australia, which provides a nice backstop.
And the eyes of the market are shifting. They're starting to look past the flu setback and are staring directly at the oncology prize. That INT data in 2026 is the main event.
It's definitely going to be a volatile year for the stock, but the floor seems a lot higher than it was just a few days ago.
This has been Talk Tickers. Keep your eyes on the tape and your stops tight.
We'll see you next earnings season.
Bye for now.